This session would probably be on YouTube. It's going to repeat some of the course materials. It's going to be posted on YouTube in case other people missed it and just to promote our classes at Drippy Finance. But basically, we're going to go over what is impermanent loss, how I think about it, and how to actually beat it if you want to. And I will clarify some misconceptions as well, like stuff like people over indexing on like impermanent loss and outperforming holding all the time. Because sometimes when the profit taking opportunity comes and you're not outperforming holding, it's often better to just take the profits and then, do another investments afterwards, right? So you never really know if you're actually going to outperform holding until the market actually has run its course. So that's something to consider. But let's dive right in here. And if you guys have any unrelated questions, you could ask them as well, and I'll go over it at the end of the session. Yeah, so this is straight up from the week 5 lessons. What is impermanent loss at the very basic level is it's also called divergence loss. But basically, whenever the price moves from your original entry, you're going to be suffering impermanent loss. Because unlike just buying and holding, you're actually swapping the different assets inside the pool, right? The pool automatically swaps based on where the price is. So if we're looking at stuff like ETH to USDC, for example, even not worrying about setting the ranges for a full range liquidity pool, you're going to be depositing around 50% ETH and 50% USDC at this current price. So the 50-50 ratio is in US dollar terms. So let's just say you would be putting in like 10 Ethereum, which is like $45,000, right? And then on the other end, you're going to be putting in like $45,000 in USDC. So if it's a full range LP. And then if the price move up to, let's say $10,000, the 10 Ethereum that you put in initially is going to be slowly sold. And we can calculate that as well. But the idea is if your asset is being sold on the way up, you're going to have less Ethereum because Ethereum went all the way to 10K. Your overall profit is going to be less than buying and holding, right? So you're going to have a bit more USDC than what you start with because your dollar cost averaging out with that 10 Ethereum that you put in. So then your net profit would be less. But again, the reason why we yield farm a lot of these pairs is because you're going to be earning cash flow in the process. If you just buy and hold, you could be earning yields from like staking and lending. But if you are looking for higher yields or you're looking to accumulate altcoins, a lot of times these altcoins don't earn any yield at all, right? For example, for meme coins, if you're yield farming Doge coin and USDT, Doge is not going to really pay you a high yield unless you put it inside a liquidity pool where traders are trading these two tokens, right? So I hope that makes sense. And if the price do drop, it works in reverse as well, right? Whatever USDC you put in this case, it's 45K. As the price of ETH goes down to, let's say 2K, a lot of those USDC is going to be converted slowly into Ethereum, right? And again, you will be at a 50-50 ratio for a full range pool, but because the Ethereum that you put in is going to be worth less and less, and then you're also buying Ethereum at an average price that is between $4,500 and that $2,000 price mark, right? So as the price goes down, you're going to actually suffer some impermanent loss. Because if you just held 10 Ethereum and $45,000 separately, you would actually be outperforming the liquidity pool, right? And a very simple exercise is just to imagine like the extreme. If Ethereum went to like $1 or to $0, you would have more money if you didn't put it inside the liquidity pool, right? Because you would have that $45,000 in stablecoin. So that's basically what impermanent loss is. You're basically using holding in the market as the benchmark with the asset that you originally deposit. And different apps like Metrics Finance or Revert, they show you the exact deposit that you put in the first place. So that's how they get like the versus HODL profit and loss from, right? So impermanent loss always happen when the prices move from your original entry. And one of the things to actually understand is if the price goes up by a lot, you didn't take profit, but the price goes down back to your entry, then you would actually have a zero impermanent loss in that case, right? You deposit at 4,500 ETH to USDC, price goes up to 10K and then drops back down to 4,500. Technically, you would still have zero impermanent loss, and then you would be outperforming holding in the market, but you don't necessarily would make more profit than if you actually took the profit when Ethereum goes up to 10K, right? That's why I always say, like, don't over index, like just trying to outperform impermanent loss or trying to beat holding in the market. What we should look for or optimize around is the net profit that we take home at the end of the day. And it's the same thing with like APR or trying to generate yield. I don't really care about like getting a 100% APR if at the end of the year I suffer too much capital losses and then I close my positions at a loss, right? So it's much better to earn a low APR if you're able to close your positions in profit. And it works the same exact way with the impermanent loss, right? Like it doesn't matter if you're underperforming holding by a little bit, but then you're closing your positions in profit rather than like trying to outperform holding all the time. And then also like missing the profit taking opportunities, right? Especially for altcoins, sometimes the opportunity comes and goes really fast. And we can take a look at an example with Pendle to ETH as well. So let's say Pendle here and then Ethereum. So again, you could go to a Pendle to US dollar chart and then pull up Ethereum as a quote asset here. So this chart means if you're able to swap Pendle for ETH, you're going to be swapping one Pendle for 0.001 ETH at this current price, right? So a lot of times if I am trying to invest into a smaller cap altcoin, I want to bet on its outperformance because if it doesn't outperform Ethereum, then I might as well just buy and hold Ethereum in the first place. And of course, the outperformance doesn't necessarily happen. You would need a more risk on market. And then also the underlying asset has to have like solid fundamentals and people actually buying the asset, right? You need a lot of things to kind of line up together. But the idea here is this is a green line, right? At my entry point, I'm buying some Pendle with my Ethereum and then pairing it inside this pool. I believe this orange line is roughly my range here for this Pendle to ETH LP that I'm trying to have a little bit more APR. So in this case, I'm not maximizing like the capital gains or trying to minimize the capital losses. I'm just trying to earn a steady like 15 to 25% APR, depending on how much the volume the pair comes. But basically when the price goes down, the same exact concept applies. But instead of thinking in terms of US dollar, you want to think in terms of Ethereum because you're actually pairing Ethereum and Pendle in this case, right? So if the price goes down, you will be suffering some impermanent loss and losing some Ethereum value of the LP. So if you deposited, let's say 10 Ethereum into this pool, the prices trend down, maybe your LP value would drop to 9 or 8 Ethereum. So that's the very real risk that you're taking if you are yield farming these altcoin pairs. And then you're betting on the outperformance of these altcoins, right? And then on the
I have a
flip side,
question, Richard.
yep, go ahead.
So, quick question. Like, I get that we are using ETH as a comparison, but why don't we still just use Pendle USD? Because if it's outperforming ETH, doesn't that mean it will also outperform USD and go up more in terms of percentage?
Yes, but you need to look at this chart to be able to see like if it's actually outperforming or not. Otherwise, you'd be like measuring the price action every few weeks, right? So this chart kind of shows you, but sometimes there is a scenario where ETH goes on like a very sharp drawdown. Like if I overlay this ETH chart here, this ETH USD chart, you can see ETH went on a sharp drawdown. And I believe Pendle was on a downtrend as well because it's like an altcoin downtrend, but ETH dropped heavily against Pendle more heavily. So then you're actually netting a positive ETH in the process if you were in this pair. I was yield farming this pair as well when this happened. And then I was able to close my position into an ETH profit, right? And then when ETH recovers, I would be making a more profit than if I were just not taking profit or doing other strategies. Does that make sense?
Yeah, that makes a little bit of sense. So,
Yeah.
like, yeah, you close with like based on the Pendle ETH chart, you closed the position that you had for liquidity for ETH profit just based on the chart, and then ETH went up again, and then you can kind of make more money from that.
Yeah, exactly. So a lot of times if I start off with 10 ETH, I want to close like at 12 ETH or 15 ETH. And then you could do whatever you want with the profit, right? Like for example, you have 5 ETH left over. You could sell some to like pay for expenses or to just compound your investment over time. So you're stacking ETH like from 10 ETH to 15 ETH, 20 ETH over time, right? And the reason why it's very important to understand again is like when these price divergence do occur, like Ethereum was still trending down, but Pendle is maybe finding a bottom here, right? That's where like you're still going to be able to make a ton of profit from that price divergence. But basically, you got to be looking at this Pendle to ETH chart when you're actually yield farming Pendle to ETH pair, right? If you're actually yield farming Pendle to USDT or some other pair, then that chart becomes a primary focus. For example, if I'm yield farming Pendle to USDC, I would be looking at this chart, trying to get in at a good US dollar entry. If I'm swapping from USDC, then I would ride the uptrend upward to try to close at a US dollar profit.
Gotcha. Okay.
Yeah.
As for
So,
bullish LPs, like bearish LP, they have their own like, setups
yeah.
just
Yeah.
downwards or retracting.
Yeah.
And I think one more quick question is
Yeah.
the percentage of tokens that or coins that we have to deposit, like the percentage. So 70-30, 80-20, 50-50. It
Yeah.
depends on if it's like the ranges, right? The bearish or bullish LP.
Yes, yeah. So let's say I set a range for like Pendle USDC. I start from like $4 to like $100 because I want more capital gains. Then I would be actually buying much more Pendle at this price, right? So the wider the upper range, the more like of the base asset. In this case, is Pendle that I would have to deposit. And then the wider the bottom range, the more of the quote asset. In this case, it would be USDC that I would have to deposit. So, but yeah, if you are, for example, doing a bullish range when the prices are really high, when Pendle was at $7, for example, and you're swapping from USDC, you're essentially buying a ton of Pendle at that valuation, right? So if you're not happy to buy at that price, then you should not be entering there. So that's something to consider. And if you're swapping from Pendle though, and you want to lock in profits, you could still be yield farming like Pendle to USDT. If price is at $7, for example, you're holding a ton of spot Pendle. Maybe your goal is to accumulate more Pendle on the way down. You could be swapping your Pendle into like a range that is, for example, like $2 to $12, right? So, and it doesn't matter in that case if the price breaks up or breaks down, because if it breaks down, you would gain a net Pendle profit. And then if the price goes up, you would make more USDC in the process. So that's also another strategy. Just hold onto your spot tokens and then wait until a price where you're ready to start to sell at, or you're ready to sell all of your holdings at. Then you could enter into that pool with your crypto holdings with the base asset. So that's also another strategy if you're trying to actually maximize like capital appreciation and stuff like that, right? But my preferred method, like if I'm swapping from the quote asset, for this case, it's from Ethereum. I want to try to get in as cheap as I can. And then I want to try to, bet on the outperformance of these smaller caps. But yeah, that's basically impermanent loss. And again, it doesn't matter if I'm outperforming holding in the market. If I close my position up here with some impermanent loss, then I would actually still be at a net ETH profit, right? Rather than like if I enter back here in February or March of 2025, watch a ton of profit taking opportunity come. And then I didn't take profit because I'm trying to beat impermanent loss. Then I watch the profit melt away and then maybe even suffer some negative impermanent loss in the process. So that's something to consider. And again, I don't really like the range chasing strategy. So it's pretty straightforward for a wide range to be kind of doing that. And then the next slide, I'm going to explain why impermanent loss should be a secondary metric. You can still be at a net loss even if you beat impermanent loss. And I will show you my portfolio right now to kind of highlight that, or this is my current portfolio. If you include all of my old positions, I would actually be beating impermanent loss on most of my holding. And sometimes it's just a bunch of like stupid mistakes. That's why the profit and loss doesn't look that great that I've made earlier on when I was yield farming in like 2023 and 2024. But a lot of these positions, for example, this hype to pump pool, it's outperforming holding because the price of hype pump actually did not diverge that much from my original entry. So even though I'm beating holding in the market, doesn't mean I'm at a US dollar profit or at a crypto profit, right? Same thing with this pendle to ETH. And again, you can use, let me pull up the Revert Finance really quick. But with if you have the Metrics Pro subscription, you're able to see this divergence loss tab and compare your performance against purely holding ETH. Of course, we never know if it's actually going to outperform ETH in the long term, but getting in at a good entry is a more favorable risk to reward. And if you're planning to buy Pendle anyway, then it's completely fine to be holding this pair, right? Simply because let's say I bought like 100% Pendle with the capital I allocated to this pool, I would still be down like 400 something dollars compared to this LP performance. But you can see it's outperforming holding in the market. Again, it means that the impermanent loss is not that much, right? But then I'm actually suffering an ETH loss here because if you click at this ETH tab and I'm valuing things in ETH, you can see that, okay, the current price is at 0.001033 on the chart that we just looked at, right? But then my starting price is slightly above that. So when that happens, you are bleeding some ETH in the process. And a lot of people make the mistake of actually closing out of their positions at this current price point, especially if it shows you like a positive US dollar profit and loss. And this could actually happen in the case where like ETH trends up in value, US dollar value when I deposit it. And Pendle actually trends up as well in US dollar value, but not as much, meaning that this Pendle to ETH chart will still drop. So this has been the case for a lot of altcoins in the last few months. You see a aggressive price movement of ETH going up, but then this Pendle to ETH chart is trending down, right? So if you deposited way up here, you would have suffered a lot of negative ETH loss in terms of negative divergence loss, right? But if I pull up the Pendle to USD chart, you can see Pendle actually had been on an uptrend as well, right? But just not as aggressive as Ethereum in the last couple of months here. So that's something to consider. If your goal is to stack more ETH profit, you definitely don't want to be entering near like the zone of resistance here because the risk and reward of betting on a breakout is not as good as entering into at like the zone of resistance, right? Or sorry, at the zone of support. So if you enter a zone of support, sometimes you do lose money if the price keeps going down, but for sure you're going to lose less money than if you entered all the way up here. So that's why it's also very important to be patient and include like a list of assets you're actually tracking and are bullish on. So on your downtime, you should not be doing too much stuff like trying to range chase, trying to rebalance all the time. You should be doing stuff like looking at different investment that you're bullish on, adding it to your list, and potentially coming back to it when there's a good buying opportunity. For example, recently I saw like a pretty aggressive price movement on Cake on BNB. I'm not going to buy at this resistance area, right? I'm going to add it to my list and then potentially come back to it if there's a good chance to grab some Cake at a cheaper price. So that's kind of how I do my strategy instead of like trying to rush the investment and get like a suboptimal entry. But sometimes I do buy at like, when the prices are trending up, if I'm comfortable in the asset, for example, pump to USDC, I entered at this green line because I believe the uptrend would continue. It did continue. And then you want to have like a contingency plan in place. If the price drop, you could do stuff like compound down into your investment to drag down your entry. But let's go back to the impermanent loss idea here. So again, this metric is not that big of a deal. What I care most about is this profit and loss metric. For example, this ETH profit and loss. You can see I'm down about 5% on my initial investment. Again, this is completely normal for alt ETH pair. You are taking on more risk on the asset risk when you're pairing these two assets together. You're exposed to the pendulum price appreciation and price depreciation, right? So if the price moved down below my entry, you're going to see this negative divergence loss number here. And this is, if you're farming alt ETH pair for the last couple of months, you probably are going to be sitting in like a negative divergence loss on ETH terms, simply because Ethereum has been really strong and a lot of these alts have not catched up yet, right? But if you expect these alts to catch up, then it doesn't make sense to lock in the loss right now, right? So you want to hold through the drawdown if you expect these altcoins to start outperforming Ethereum again. And once again, ETH price could go down, but if it goes down more than like these altcoins, you're still able to close these positions at a positive profit and loss. And if you guys go to the mind map, I've actually included this chart and I will update it as we go along as well for the mind map, kind of clean it up a little bit. But yeah, it's included with the course. And what you will see is that this chart shows like the impermanent loss, right? If the price goes up in the case of Pendle to ETH, meaning that Pendle is outperforming ETH, then you would be having a net ETH profit just from the impermanent loss alone, right? So the divergence loss is actually a divergence profit. And I call this positive impermanent loss because I actually want that to happen. And, it doesn't matter if the fees are not that much because you're still able to close at an ETH profit, right? But then if the price do swing back down below your entry, then you're going to have negative impermanent loss. This is what is happening to my Pendle to ETH pool right now because the pool is still relatively new here. You can see like 20 days old, but it's still a relatively new position for a wider range strategy. Sometimes I'm in range for like 6 to 12 months or even like 2 years at a time. So this position is new. And if the price do swing down, again, you're going to have this negative divergence loss, right? So you will be net unprofitable if there is too much negative impermanent loss. This is why we don't want to be yield farming pairs that bleed out against Ethereum or against major assets because the asset is going to be too weak. And then the fees that you generate might not be able to cover the impermanent loss over time, right? And one scenario that could happen as well is like, instead of the outperformance kind of like fluctuate in the case of Pendle to ETH, you could be seeing like this line going straight downwards, right? And then you're suffering a ton of losses in the process. So this is why we don't provide liquidity for assets that bleed out. There's a lot of investments to choose from, so you don't need to be taking that risk. And then if the prices do swing back up, in this case, you are having more positive impermanent loss than the fees or the divergence that you suffer. You're profitable, but not beating holding in this case. And this is completely fine because you can still close your positions at a profit, right? So again, I would rather just close my position if I expect that, the drawdown is coming, or if I'm just happy with my conservative profit target, I would exit my position because if I see a big drawdown here, I could always enter into a new position and then ride that impermanent loss, the positive impermanent loss back up again for another wave of profit. But if you do hold down below into the drawdown once again, but the fees kind of cancel out the impermanent loss, then you're going to be pretty much at break even, right? And some of my positions, I believe, is close to break even. It's in slight profit. You can see mark to ETH. It's earning quite a high APR. That's why it's able to stay in profit, where the fees still outprint the negative divergence loss, right? But again, the ideal scenario is that the token price goes on an uptrend. I would have a positive impermanent loss. And then I'm also earning much more yield on top of that. So if this pooled asset goes up from like 1.3 ETH to 2 ETH, and then I'm also earning 50% APR or more on top of that capital, then the actual net APR on my cost basis is going to be really, really high, right? That's why it's important to try to get in at a good entry and on tokens that you believe are going to outperform Ethereum. And of course, betting on outperformance is not going to happen every time. In fact, when the market is really weak, the outperformance is going to be rare. But the idea here is you got to try, right? A lot of people just yield farm pairs without even looking at like the potential outperformance. So this type of like mental framework is much better than like walking into the pool and being blind to these concepts. And then ideally, you will be suffering impermanent loss in the positive side where you're like dollar cost averaging out of that asset. But then the fees is also greater than the impermanent loss. In that case, you're actually beating like holding every single asset, and then you're actually outperforming impermanent loss as well. So you're going to be beating like multiple metrics in that case, right? So if you measure like the profit and loss, let me see if I could find a position here. Maybe did a smog to ETH pool. So it is down a little bit for like against 100% ETH. But if I do see like a big positive impermanent loss for like this pair, then I would actually be outperforming all of these four metrics, right? Holding the initial asset, holding the asset 50-50, 100% MOG, 100% ETH. And this typically can happen over a long period of time if that is your goal. But you can profit from impermanent loss in the examples that I just gave, right? And then, for example, for Pendle to ETH, even though Ethereum's price was trading down, you could be closing at this zone of resistance for an ETH profit and basically benefit from the impermanent loss. A lot of people just fear impermanent loss, but instead what you should be thinking is like, okay, how can I profit from this divergence in price, right? When an asset decouples, there's a lot of good profit taking opportunity. And this works for like ETH to Bitcoin pairs as well, right? For example, if I enter down here and then I'm holding a bunch of Bitcoin, I could actually be riding that trend upward. And then I could close my position here at a Bitcoin profit, right? If I'm trying to actually get a net Bitcoin profit. And this is kind of how you want to think about it. And in this case, ETH is no longer the quote asset. Bitcoin is a quote asset. So if I'm a Bitcoin whale, I want to enter where ETH is cheap compared to Bitcoin because I'm essentially buying ETH at that price point, right? What I don't want to do is swap a ton of Bitcoin at this very high ETH to Bitcoin price to either hold or to actually yield farm, because then if I ride the downtrend downward and the fees is not enough to cover the impermanent loss, it would be this scenario two here, right? Where I would actually suffer too much negative impermanent loss and then suffer a net Bitcoin loss for that pair.
Richard, quick question.
Yep.
Do you mind going back to the chart
ETH Bitcoin.
for
Yep.
ETH Bitcoin? So, for example, right, let's imagine a case where ETH and Bitcoin are like both kind of high. And so the charts for ETH Bitcoin is at like a high point. If Bitcoin and ETH both go down, but ETH goes down slower, does that mean that the chart for ETH Bitcoin would go up? Because the ratio of the conversion is still the gap would widen a little bit. You know what I mean?
Yes, yes. So if Bitcoin goes down more than ETH, then yes, ETH Bitcoin would go up because then you're able to swap more ETH for more Bitcoin, right?
Got
Yeah.
it. Yeah.
Yeah. So
Because
if,
ETH would also
yeah,
go down, but instead of like 10% drawdown in Bitcoin, maybe ETH is only 4%. The chart would
yes.
still kind of trend upwards. Okay.
Yeah, yeah, that's correct. That's a great catch. Sometimes it does happen, and usually like the lower caps would bleed more than the larger caps, but that doesn't necessarily happen all the time, right? Like what we saw with Pendle to ETH that I gave an example of. The same thing could happen with ETH to Bitcoin as well. If ETH goes up a little bit and then Bitcoin's maybe just move sideways, the chart would also go up. So yeah, that's why it's very helpful to just look at the relative chart rather than, just looking at the percentage gain day by day, right? So
Richard, I had a question as well. If you could go to the Pendle ETH chart and let's assume that we are entering at a point, it's a neutral territory. So we are going for a 50-50 split. And let's say Pendle drops real bad towards its support. It's closer to your pool being out of range. So you said you wouldn't withdraw it and you would probably add more resources there. So is there a point where you just cut your losses and say, okay, this is not working out if
yeah,
it drops down even further?
yeah. So if my thesis is kind of like invalidated and I've been waiting for like months, and then there are some other better investments that I could put into, then I would actually consider like cutting my losses and then rotating into other assets, right? And that's the risk with altcoins. You are taking that underlying asset risk when you're yield farming this pair. So it doesn't matter if you're using a tight range or a wide range. If you're yield farming this pair, you're betting on Pendle outperformance, or at least like trying to keep up with ETH in value, right? And this is why like it's not a great idea to go like too heavy into just one pair, unless it's like a blue chip pair, like stuff like ETH to Bitcoin or something. Yeah. But I usually do compound down if I expect the upswing is going to come in the next like 6 to 12 months. And if I don't compound down, then one of the things you could do is you could rebalance the lower range down to kind of be near that bottom price, right? So let's say Pendle to ETH drop to like 0.0005. You want to rebalance the lower range, but then you also want to drag up the upper range, because if you only drag down the bottom range, then when the prices bounce back, if it does, then you're going to get a bad exchange rate. And then you could also lose ETH in the process if it does recover back to your entry. Yeah. For DeFi projects like Pendle, another thing you could track is like the actual metrics behind it, right? Like the total value locked, the revenue it generates, how many people are locking their Pendle into vPendle, stuff like that.
Good. Because the reason I ask is sometimes the fundamentals don't really match the token price. Something like a Jupiter, the team is constantly, and it's very bullish, but the token has just been dropping. And
for Jupe, I have no idea like the story behind it. Maybe something unusual is going on. Sometimes it's just like the token unlocks, or if you give too much of the token as rewards. I'm not sure if that's the case with Jupe. Then like, the price is going to struggle, right? And then also in 2025 in general, altcoin has been pretty weak relative to 2024. It could just be that Jupe was overvalued in 2024 as well,
sure.
Yeah. It's hard to say like if the price is going to go up or go down over time, but the idea is we still want to try to bet for outperformance, right? If you're like, but yeah, like if I look at the long-term chart of Jupe, then it does seem like it's kind of bleeding out against Solana. Of course, you could try to bet on a reversal, but it's still going to be much riskier than, betting on charts like Pendle, where like historically it has been like fluctuating between outperformance and underperformance, right?
Gotcha.
Yeah, it's always a tough call to like, should I cut losses and stuff like that? And is there like a better investment opportunity? Yeah. All right. So we could continue if you guys don't have any questions so far. Yeah. So the idea behind like impermanent loss is that it could be a good or bad thing depending on your goals as well. If you're trying to bid more Pendle, for example, then like having a negative impermanent loss is not a big deal, right? So Pendle to ETH, if my goal is to buy more Pendle into the drawdown, then having that negative impermanent loss, then it doesn't really matter, right? I could be entering here and then setting a wider lower range to capture that drawdown, and then it would not matter in that case. So it's very like goal dependent as well. But if I want to dollar cost average out, and even if Pendle goes up by like 3x against Ethereum, so up to 0.003, and that's not a big deal either, because I would be actually gaining a net ETH profit. So the idea behind like yield farming these pairs is that you got to be okay with both scenarios. So, but it's good for capturing an explosive move upwards and de-risking if you guys set a wider upper range as well. So when this price swings back up, if I close my profit into ETH, I'm basically de-risking out of these like smaller cap altcoins, right? And that's typically what I am looking to do. If the market feels a little bit overvalued, there's a lot of greed in the market, and maybe the project has kind of peaked for either like this swing up or for the cycle as well. So that's kind of what impermanent loss is. And you got to realize is that profit is still profit, even if you underperform holding by a bit. The reality is most people would not be patient enough to hold their spot bags for massive gains or be able to time the market top. So we should be happy with like the profit we take. even sometimes it's like very small profit, 5%, 10%, that will compound over time, right? And it's better to take profit than be suffering a loss in your investments. And liquidity pools do prevent round tripping and giving back all of your gains as well. So in the case of Pendle to ETH, even if I enter way back here in 2024, I rode the trend upward, downward, upward, downward, I would still be probably in a net profit if the APR is high enough, even if my entry is slightly above, right? Or if I compound it down a bit when the prices are really cheap, then it's going to drag down my entry. And over time, it's going to, even if I round trip my bags, I would still be in a net profit. And this is especially true for like stuff like ETH to USDC. And again, I do recommend for most investors to have the bulk of your portfolio in like blue chip assets, stuff like ETH, Bitcoin, stuff like that. So even if you lose some money with the altcoins, it's not going to actually destroy your portfolio. And again, I suffer like pretty much a scam in the last few weeks. So I did lose a core holding. I was supposed to have, close to like 60 to 70K in like ETH to USDC. So I wouldn't be that heavily into alts normally, but basically, even if ETH price drawdown, right, you could compound down when you suffer negative impermanent loss. And even if you round trip your bags, so if you enter at 2,500, price go up, price go down back to 2,500, with liquidity pools, you would still make money. That's why we yield farm in the first place. And let me show this position, this client position. Basically what happened was we entered this SOL to USDC pair when the price of SOL was trading at 176. And of course, you could take this as a swing trade as well. But the reason why we went in with a yield farming pair is because if the price just moved sideways, or if we round tripped our gains, again, we would still be at a net profit, right? Rather than like a swing trade, if you did not take profits at your profit target, or if it just missed your profit target by a hair, then you would actually be round tripping that gains, right? So even though underperforming holding by $1,500, I would rather much secure that profit, close that position when I'm happy with that profit, and then I could use that extra profit to reinvest into something else, right? We deposited around 50K, made 10K with profit, and okay, the price did hit the exit target at like roughly $250. We exited at 245, and then we just booked that profit from there. So even right now, SOL is trading slightly below that $250 mark, right? Is SOL going to go to like $300, $500? Maybe, and probably this cycle, in my opinion, it's quite likely that SOL's price is going to move higher. But this is more of a more conservative exit target for like the mid to short term investments, right? And then it's not like we just go into stables and then we can't use the investment for something else. So we did rotate into stuff like pump to USDC, and then we could be yield farming that next opportunity. So don't over index on like, versus holding. Even if you're at a really nice profit, you're underperforming holding by a little bit. It's often a good chance to just secure the profit and just don't worry about this versus hodl number at all. And this could actually happen in a lot of cases if the price movement is very, very aggressive. Even on altcoin pairs, if we're looking at stuff like Tau to Ethereum, you can see the current Tau price compared to its all-time high is at about like 3x of this current price, right? So if your range is not sufficiently wide, you will be suffering more impermanent loss than if you had like a really wide range, right? So in that case, it would be harder to outperform holding. But does that mean that we should not be closing out our position when Tau is overvalued compared to Ethereum, right? It doesn't make sense to be like, not taking your profits at all in those cases. Yes, Tao's is saying Tau to ETH is almost at like the peak or bottom. I do believe a lot of these altcoins are at a pretty cheap valuation. That's why I'm still holding on to my altcoin bags. There's a lot of things to choose from, stuff like Tau, even Ondo. There's a lot of different pairs that you could take, right? And it is based on what you are researching and what you're bullish on. Again, I'm not here to actually tell you what to invest in because I do make like bad decisions sometimes. And you have to actually do the research yourself to have the actual conviction in the token and making sure that all of the data is correct. So I never invest based on like other investors' analysis or like other people's report unless I actually took the time to look at the data myself. So that's something to consider. And does that mean that you should not be looking for like alpha from other people? No, right? You should be like looking at other people's analysis, but you should take it at like, face value and kind of use it like a grain of salt thing and don't just like invest based on what other people say. So again, you want to optimize for making and keeping profits instead of trying to beat holding or trying to beat impermanent loss over time. But how do we actually beat impermanent loss pretty consistently? Because a lot of times these altcoins do fluctuate between like outperformance and underperformance, right? And you can see that I've had a pretty good track record if we are comparing against holding. You can see versus hodl up like 20 something K, even though there's a bunch of positions that are like really high risk and sometimes really stupid, right? And some of them are like pretty experimental, stuff like the Vader to ETH. I was testing like a strategy. Of course, this did not work out. And then there's just a bunch of other mistakes as well. But sometimes I do close position at a US dollar profit because I'm taking a leverage setup. It will show like a loss on some of these trackers, even though I did close at a profit. But the idea here is a lot of times we are able to outperform holding by a lot. And I'll show you how to do exactly that. So again, it's inside the course, but basically these are the core things that we want to focus on if we want to beat impermanent loss. The first is to set wider ranges. The wider your range, the less impermanent loss you're going to suffer. The reason why is the exchange rate is not going to be as aggressive, right? If you set a full range ETH to USDC pool, for example, and ETH moves up by like 100%, you're going to be selling your ETH at a slower pace than if you set a tight range LP that is about like 15% wide or something, right? So wider ranges always lead to less impermanent loss. And the second idea is to stay in range for a very long time. And this could depend on the pair you're yield farming. For most altcoins, I want to give it a chance of about like 6 to 12 months for it to outperform before I think about, maybe rotating some of my investment. I want to give it like a fighting chance, right? I don't want to just be like yield farming this pair, give it like 2 weeks and then call it quits because the price don't look good. So you do have to give like the time for the price fluctuation to happen and for the market to fluctuate between like a good market to a bad market, right? So the market fluctuation happens all the time. For the Pendle to USDC here, even on the USDC pair, you can see the price fluctuates all the time. And then if you do look at the Pendle to ETH pool, again, the price fluctuates all the time, right? So we want to stay in range for a long time. And the first is because of the price fluctuation. The second is because of this chart, right? The more fees you accrue over time, the easier it is going to beat impermanent loss. Even with like very aggressive price movement, if the fees is enough over time, you're still going to be outperforming holding in the market. Again, this is the ideal scenario where the fees do outperform the impermanent loss. You're beating all the metrics, even if you're holding like Pendle separately, holding ETH separately, or just holding whatever assets separately. You're outperforming all of that. And it does happen if the fees are enough and you stay in range for a very long time. And then the second best is this scenario where the positive impermanent loss is greater than the fees. So that's the example of the SOL to USDC that I showed you guys, right? Where there's a good opportunity to take profits. I had no idea how the price is going to moving into it, right? I could kind of guess, but the price could have just grinded sideways for the next 6 months. And then I would still be, at a slight profit and very low impermanent loss, right? But if the price do move up aggressively, it's often a good idea to secure some profits if you're sitting in profit. And, if you do get into a drawdown, sometimes the best course of action is to just pull through and then wait for a recovery so that you could close your positions in a profit. But the longer you stay in range, the easier it is to beat impermanent loss and beat outperforming holding in the market. The third thing is
question.
yeah, go ahead.
Can you go back to the chart?
This chart.
Yeah, so like you mentioned staying in range, right, for a long time, and you mentioned having like a being in a pool that has a good fees. But what are examples of these? Like what do you look for? Like what's a good fee? 0.3, 0.2, 0.5, and what is long like a good enough time duration to be in the range?
So it all depends. For this year, it has been a bit tougher because the APR, the on-chain volume has been relatively low on some of the months. For example, like the last 2 or 3 months, there's only like a few really hot pairs, right? And a lot of those hot pairs are trading at like pretty high valuation. So the risk is quite high. But let's just say let's just take a look at this Pendle to ETH pool here. So my range is at 0.008 and then upper range is at 0.00225. So this is tighter than what I would normally do, but the reason why is because I am holding some spot Pendle bags. And if the price do move up, then I could sell my spot Pendle bag for a profit. So that's a way to hedge the upside as well. So even if I underperform holding by a little bit, I still have that holding strategy on the side, right? But to answer your question, let's say this was my entry, which it roughly was. And what I want to do is I want to kind of simulate like that impermanent loss, right? What is a realistic price target for Pendle? Maybe this zone of resistance here, but maybe we're not that greedy to try to wait for the ultimate top. We front run it a little bit. So maybe like 0.0019. Price now is at 0.0019. So that's how you could actually simulate the impermanent loss, right? So you can see you would be underperforming holding by just a little bit for this scenario. If you deposited 10 ETH holding in the market at this price, you would have like 14, 15 ETH, right? And then in the LP, you would have 12.68 ETH. And then for this scenario, your APR would have to be greater than this 15% to actually outperform holding in the market. But again, does it matter if you outperform holding? It doesn't really matter that much. If the profit is there, we want to take it. But ideally, the APR should be greater than this impermanent loss number over time. And if we look at the Pendle to ETH pool, one second, open position. So right now the APR is at 21%, right? So last year it would have been much easier to outperform holding in the market, but I'm still outperforming here if the divergence loss is not that great. But if the divergence loss is greater where if Pendle moves up or moves down, then earning a 20% APR over 1 year would allow me to outperform this impermanent loss, right? Basically, the idea here
By like
is,
5%.
pretty
By like
much, yeah.
5%, right? So technically you're only getting a 5% APR for that year. Or well, no, because you're also
Yeah.
get the fees, right?
Well, you are getting like 5% more than if you're just holding this pair. So, but your net profit could be like, for this case, the net profit just holding in the market would be like roughly almost 50%, right? But if you are yield farming this pair, maybe your net profit is like 55 or 60%, depending on what you do with the fees as well. So that's how you could kind of like get more profit out of it. But the reason why we still yield farm anyway is we never actually know like if the price is going to move up that aggressively, or maybe the price just moved up by a little bit in 1 year, right? Then you will see that the impermanent loss would have been only 3%, but I would have been earning like a net 17% return on my capital, if that makes sense.
Okay. Yeah.
So, but yeah, the longer you stay in range, like let's say I stay in range for like, if it's 20% APR per year, then I stay in range for 5 years, right? I would earn like 100% APR in total, and then basically get my investment back, assuming that the asset stays around for the next 5 years or so. Of course, throughout that time, I would have to stay in range, right? So in that instance, I would be outperforming the impermanent loss. And again, you can always expand your range to minimize the impermanent loss, right? A very extreme example is like a max range and a lower range is at 0. And then even if the price fluctuate, like let's say to like 0.0019 to what we were seeing, the impermanent loss is very minimal at like 3.7%, right? So if my APR is like 4%, 5% for the wide range, you would still technically be outperforming just holding in the market. And it's just better to be yield farming in that case if you're fine with like holding the underlying asset. And it's not very likely for a lot of these altcoins to be outperforming like ETH by like 10 to 20x, or you would be suffering a ton of impermanent loss unless you're actually holding a lower cap token that is like below 100 million market cap or something, right? Or like somewhere between 100 million and 500 million market cap would be a bit bigger in that case if there's a parabolic move upward. And for those scenarios, one very simple way is just to yield farm with a portion of your portfolio and then hold a bunch of it in a spot bet, right? And that's what I do with tokens like Pixel that I'm bullish on. Again, I'm not telling you guys to buy Pixel, right? If you want to buy it, you want to do research on the particular token. But you can see I'm holding a bunch of it in the spot bag, almost like 25, 26K worth of Pixel. If this goes up by like 10x, 20x, 30x, of course, the impermanent loss is probably greater than what I would be able to generate in the APR. But one of my goals is not to actually keep generating APR, is to de-risk out of Pixel and into Ethereum, right? It's allowing me to sell some of the Pixel on the way up. I could withdraw my liquidity, lock in some profits if Pixel goes up by 5x or something, right? Or sell some of my spot backs to lock in some profit when that happens. So, but these assets, again, you got to be bullish on for the next 6 to 12 months at the very, very minimum, but ideally something that you would invest into anyway, into a bear market. So that's the best way to do it, especially since we're closer to the end of a regular 4-year cycle rather than like the start of it, right? If you're worried about the drawdown, you definitely should not be yield farming too much altcoins or deploying into too much altcoins at this current price point. You should be only using a smaller portion of your portfolio. And what I am doing right now is like, I'm actually selling a lot of my fees into stable coins or into major assets like Bitcoin to ETH to de-risk rather than like compounding my fees, right? So, but the idea is if you do all of these things, you're going to be able to have a much higher chance of beating impermanent loss. And then again, if you provide liquidity for crypto pools, this could also minimize impermanent loss simply because a lot of these crypto assets are correlated to Ethereum or to Bitcoin. So like when they move up together, you're not going to have that much impermanent loss, right? So that's why like the Pendle to ETH pool right now is still outperforming holding in the market. It's because the price movement hasn't been that big, right? Even stuff with like a hike to pump, if the APR is greater, it's also much easier to beat impermanent loss as well. Even with like crypto to stable pair, I am beating holding in the market simply because the APR is high enough. But again, don't just be blinded by the APR. You want to actually be bullish and then also like do research on the underlying assets, right? So you should not be yield farming like the different assets that you actually don't want to accumulate or to buy at this current valuation. But that's basically it. But if a token bleeds out, that's how you could suffer a ton of impermanent loss as well. If we go back to the previous ranges for Pendle to ETH, if the token bleeds out over time, you can see if it goes to 0, then it's like pretty much 100% impermanent loss, right? And we do see like 90% correction all the time for like the riskier altcoins. So that's also something to consider. And that's why you should not be like putting all of your portfolio into these altcoins. But yeah, like the overall thing about impermanent loss is just like expect it to happen. You could do stuff to minimize it or try to beat it. But again, our goal at the end of the day is just to try to secure as much profit as possible, right? I think some people like over-index impermanent loss, over-index APR, but they're missing like the big picture of like actually optimizing for profit. Because there's a ton of different pairs that taking profit would just be a better choice, right? Like for example, I was yield farming bond to ETH. Right now it's at a very good entry. So if I want that asset, I would be yield farming and entering at this current price. But if you set like clear exit target, it oftentimes is a better choice to just exit the pool, regardless if you're actually like beating impermanent loss or not. But for like longer term holdings, if you're planning to like hold onto a particular asset for like longer time period, maybe like bump to soul as well, and you're comfortable like riding that into the bear, then of course it's going to make it much easier to be in prompt loss, right? The higher the APR for these pools, the easier it is to be in prompt loss as well. So I guess that's pretty much it. If you guys have any questions, you could ask like in the Discord and either the forum or in general. And then, yeah, I'm in there all the time. So thanks for coming, guys. Unless you guys have any questions, I think we could call it a day for now.